Hello, Michael Monatskine here, creator of the Ultimate Creative Finance Real Estate Investment Calculator, as well as plenty of other tools to help you on your financial independence journey. So what we're going to do today is I'm going to show you how to underwrite a creative finance deal. This property is a straight subject to property, so we will be underwriting this one together using the hybrid creative finance tool. So just like you would, what we start off is you get a link to this copy document spot. All you got to do is make a copy. As I recommend, put so for this one, I'll do Columbia SC for Columbia, South Carolina. I'll make sure that it is moved over to the right folder. For me, I'll just leave it as is, but you just move it into whatever folder makes sense for you. And let's start. So this property is, let's get the address. Great. This is a 4-bed, 2-bath property. Looks like fully renovated. Cash flow as long-term rental is what it says. And the rate is 675. Okay, to put arrears in the back of the mortgage. So this property has arrears. So there's loans that need to get paid off prior to the sale. However, it sounds like what the seller was able to do is add the arrears, the missed payments to the back of the mortgage. So as long as the loan stays in place, this amount will have to get paid off right away. It'll get paid off over time. So that's interesting. Okay. We'll do the rental income. Well, let's get right into it. Let's go into let's get the address. Let's just say, I don't know, 2,500, which probably is high for the area, but the tool will let us know. 4-bed, 1.5 bath, or greater than 1.5 bath. Yep. So it says rent, the median rent is $19.25, and what you can see is our subject property orange. There's a few other properties, so blue is similar in rent, green is a little less in rent, red is higher in rent. So there's 21 properties that are similar, that are somewhat similar within a 1.5 mile radius, and luckily there's a few that are similar rent right around it. So stick with $19.25 per month. And then let's get back to it. What was it, $19.25? Yep, $19.25. All right, so in this deal, the mortgage balance is $209,000. The overall purchase price is $236,000 plus closing costs and transaction coordinator fees. So for right now, we'll put $236,000 as the purchase price. What we're going to do is we're going to go fill in the information for the existing Subto loan, which is right over here. So we don't know the original loan amount. No. We don't know that. We do know the interest rate, which they said was 6.75. 30-year term. First payment date, that wasn't listed on here either, which is fine. So what we're going to do is we're going to have to manually input these values. So, and sometimes that's what, you don't get all the perfect info that you want in the exact format that you want. This would be a good thing to follow up and request from, in this instance, from the wholesaler. But the Subto loan amount that we're taking over is $209,000. For right now, let's put a 0% down payment. That shows there's $27,000 that needs to get paid. The assumption is that full amount is being paid to the seller. However, the wholesaler is going to want some of these funds too. So that's what I'm assuming is included in this, because there doesn't say wholesale assignment fee. So this 236 is a combination of the Subto loan, right? The 209,000 that you're taking over, money you're giving to the seller, and money that you are paying the wholesaler. There might even be agent commissions. We don't know, but yeah. So we're going to do our best to make sure that the entry costs are right. The entry costs are going to be the difference between the 236 to the 209, which in this instance is 27,000. So let's just put it really doesn't matter in the grand scheme of things. Let's put the down payment to the seller is, let's change the purchase price to $226. Let's make the down payment to the seller $17,000, and that extra $10,000, that's the money that will be going to pay the wholesaler. There is no agent involved, is what we're assuming. So we're still getting the same, right? We're still getting the same purchase price plus wholesale fee is still going to equal the $236. We're just separating what is going towards the seller and taking over the loan versus what is going to the wholesaler. Rehab renovations, they say it's fully turnkey for the time being. We will say that that's the case. Closing costs, we'll estimate 2%. That's fair. Couple $100, $500 to set up your LLC, and an inspection probably be closer to $750. And then carrying costs, 3 months of expenses. So let's just continue on. So in this instance, we have the purchase price minus the $17,000 to the seller, the down payment, the $209,000 loan taken over sub 2. So that 226 minus these two leaves no other equity to worry about. And if we left it at 236, we'd have $10,000 to worry about. But we're just taking that out of the purchase price and just paying it directly to the wholesaler here, because that's a better assessment of our entry cost, of where the funds are actually going to go. So what is calculated over here is $1,297 a month and principal and interest on the loan. However, we don't know what the original loan amount was, so none of this really matters. What this info is inaccurate at this point, so I'm just going to get rid of it. And what we're going to do is we're going to replace this value with what's provided here, even if it's the principal insurance, principal interest, taxes, and insurance, which is $1,369. And actually, what we're going to do is we're going to set this to $1,000, and then we're going to account for the remaining $369 here. So we'll say that the insurance is $100 a month. So this property taxes, this amount here is going to equal $1,369 minus this $1,000 we're saying is on the loan, minus the $100 for insurance. So $269 a month. Because you're supposed to input the value annually here, and it adds, and then it just divides by 12 here, you'll just need to change this to equal 12 times the monthly amount, so you get the right annual figure there. And then any other, typically for a single family home, you're not going to worry about any utilities. You're not going to be the one that has to worry about paying those. So you can set everything to 0. You're going to want a property manager at $193, and your reserves are going to be 8% for vacancy, 15% or 10% for maintenance and capex. So let's continue. Let's continue along. So I can already see this deal is just way too tight, but let's see. So let's see. So we have your entry costs, we have your income, we have your expenses. That's all good. So what this is saying is, with these terms, you can cash flow approximately $17 a month. That's not great. And it's only 0.56% cash on cash return. So your annual cash flow, right, $204, your annual cash flow divided by your $36,000 to get into the deal, that nets you a 0.56% cash on cash return. Even if you don't account for this $347 for reserves, you would only have $364 a month in cash flow, which translates to 11.9 or approximately 12% cash return. So that's kind of like your best case perfect scenario. There's no vacancy, no maintenance needs, no capital expenditure needs. That isn't very realistic. That shows you, like, in the perfect scenario, how high can your returns be? And on the more average or standard scenario, it's going to be much lower, barely breaking even. If one little thing goes off, you're very you're at risk. Or if it rents for $25 less, you're already making negative cash flow. This wouldn't be a deal for me. However, let's see, what can we do differently? Because this is a subject to loan, there really isn't much that you can change to increase the cash flow. Your cash flow is just your income minus your expenses. Your expenses include your debts, your taxes, your insurance. Honestly, your taxes could probably go up, will probably go up depending on if this property had exemptions because an owner lived in it, or if just because the new price might be higher than what it was previously assessed at. So honestly, your taxes are probably going to go up. There's really no wiggle room to increase your cash flow unless you're going to say your rents are going up substantially, but that's not necessarily that's not a good thing to bank on. You want to just use the values that are there. So then, because you can't increase your cash flow, the only thing you really can do is reduce the entry costs. And the only real entry costs we see here are you're going to pay for the down payment. Right, you're paying the seller the down payment. I mean, there's a combination of 17,000 plus 10,000, so 27,000 between the seller and the wholesaler. Maybe all 27,000 is the wholesaler, maybe 5,000 is the wholesaler, maybe 10. We don't know. We just know the 10,000 plus 17,000, 27,000 total is split between the seller and the wholesaler. So let's see. There really isn't a ton you can do. You can try to negotiate down the assignment fee a little bit. Maybe you lower the purchase price to $216,000. So now the amount that you're giving to the seller is only $7,000, and you're still giving the wholesaler $10,000. Because the cash flow is still so tiny and minimal, your cash on cash return hasn't changed substantially, and your cash flow is still the same. But you can see your cash return has gone from 12% to closer to 16.5%, almost 17%, because we're able to substantially reduce the entry cost. Although this still isn't very ideal, because this just deal doesn't really work, and that's one of the tough parts of subject to deals. There really isn't a ton that you can do because you can't really increase the cash flow because your monthly expenses are fixed. The main one being your taxes, insurance, or your loan payments, your principal and interest loan payments, your taxes and your insurance. Those are basically fixed. There's no other expenses that you're accounting for. All that's left are management, vacancy, maintenance, and CapEx. So this one definitely does not seem to be a good deal, and there's really no viable path to make it a good deal. What you could consider is, let's just use their numbers for midterm rental and see if that's viable. So for a midterm rental, let's say it's approximately $15,000 to furnish the property. That will increase your entry cost. The midterm rental income is approximately, let's say $3,000, right in the middle between their estimations, which is kind of a pretty large range. You're going to now cover the utilities, so we'll say $450. And let's see what that looks like. So in this scenario, actually, you could make this one work as a good midterm rental, netting you approximately $431 a month in cash flow and a 12.6% cash on cash return, even with the $15,000 increase to furnish the property. So assuming you don't have any renovations to do and that the property just needs to get furnished and you can furnish it at $15,000, this could be a great deal in this scenario. In regards to short-term rental, well, I will say at $37,000, it's not worth it because you're going to spend more each month. So at $37,000, I'll just estimate what that looks like. At $37,000 a year, so equals 37,000 divided by 12. That's basically the same as your midterm rental, but you're going to have to spend more to furnish it better. You're going to have to pay more in monthly commissions, a higher property management fee, all those things. It doesn't make sense unless this short-term rental income was maybe over 40, 50, 60K. It doesn't make sense when the midterm rental can get you similar, if not better, returns. But you have to do your due diligence to make sure that it works for that. So that's quickly how you can underwrite this creative finance deal based on the information provided by a wholesaler. For me, this would be a no-go as a long-term rental. I still might pursue this as a midterm rental, but I would prefer to see that the entry costs themselves are lowered a bit from the approximately $27,000 to maybe closer to $20,000 to $18,000 as we looked at. Cool. So if you want to stay connected, feel free to reach out to me on Instagram, Michael MNAT, or YouTube at Intentional Investor. Thanks.